Good evening, everyone. Welcome to our Irvine Homebuyer Workshop. My name is Jason Maida. It's great to be with all of you this evening. Really excited to bring this information to you. We're going to get started actually right now so we can kind of stay on track for tonight's timing. Tonight's discussion is going to be kind of an open dialogue. So as I go through tonight's slides, feel free to kind of chime in with some questions. Ken Fleck's going to be handling the Q&A for us. So as we have some questions in tonight's content, feel free to Ken will bring those to our group, and then we'll kind of share those with the greater audience. So let's go ahead and jump in. And by the way, tonight's discussion, we try to keep it right around an hour or so. So we may run over a little bit from that time frame just because of Q&A and whatnot, but we'll try to really keep us on track this evening. For those of you that I haven't got a chance to connect with in the past, I do know we have some past graduates, I guess, of our Homebuyer Workshop that are attending tonight. But my name is Jason Maida, and we've partnered with UC Irvine for the last, I think, going on 4 years. Really excited to share these workshops with us, with the UC Irvine group. We do these about once a quarter to get a chance to kind of just share with you a little bit more about what that journey towards home buying looks like. In fact, funny enough, before we started tonight's call, I got a chance to talk to one of our UCI workshop graduates who just actually got an accepted offer on their house. So got a chance to congratulate them, and they're going to now start going through the escrow process, which all of you who are joining tonight are going to learn a little bit more about that in just a few. So, but I'm based out of our Sacramento office here in Northern California, but we service the greater, well, really the West Coast. We also have some partnerships on the East Coast. Our company is a nationwide lending organization. I've been in the lending industry for just over 20 years, and I specialize really more on the first-time buyer side of things. So we work with a lot of clients that are just kind of getting started on their journey towards home ownership. We are specialized in assistance programs. So tonight you're going to learn a little bit more about the CalHFA assistance that can help with both down payment and closing costs. You'll also learn about some of the core products for first-time home buying, conventional loans, FHA loans, VA, USDA, and like I mentioned, we'll talk a little bit about those CalHFA loans as well. Here's tonight's topics for this evening. We're going to look at the housing market. Obviously, lots to talk about because we're at March 8th, so we're entering the spring buying and summer buying months, which tend to be a little bit more busy for us, especially in the industry. We're going to talk about kind of what it looks like as we kind of examine both the Orange County and LA County markets. We're going to look at some does buying make sense for us? We're going to look at some kind of a budget tool that we're going to share with you. We're going to talk about credit. And then we'll transition to different loan programs that are available to you, what some of the qualifying parameters look like for those, some of the documentation that you'll need for both income and assets for your home buying. Again, we'll look at those assistance programs that you can take advantage of. And then we'll kind of wrap up tonight's conversation looking at the loan process. So to go from a pre-approval to when we get our keys to our house, what does that all look like? And then I'll kind of share with you really briefly about what a personal consultation entails. So when you think about home buying, this is probably going to be one of the largest purchases that you make in your lifetime. So the fact that, all of you that are joining tonight's discussion are kind of investing in your financial futures by listening to us for about an hour tells you that obviously you're taking this very seriously, and it's a big investment. So it's probably going to be one of the biggest ones though we make in our lifetime. And when we look at home buying, there's a lot of great benefits that come along with it. The ability to create stability in your housing payment. This is an asset, so we can hopefully pass along that asset to the heirs of our estate. Potential growth in equity. So when we look at how much we owe on a house versus how much the house is worth, that difference is called home equity. And there's still tax benefits that come along with home buying. So there was some tax changes that came about in 2018, but you still potentially can deduct the interest on your mortgage that you pay every year. In fact, right now I'm getting a lot of messages from clients getting ready to file their taxes because they're looking for their 1098 statement for mortgage interest paid for the previous year. So let's kind of start off tonight's discussion looking at our rent versus buying calculator. So I'm going to go ahead and click on this calculator link, and then we'll kind of drop into our browser here, and I'll walk you through what this looks like here. So bear with me for 1 minute. Oops. On screen, and there we go. Okay, so this is a rent versus buy calculator, and it's a tool that's brought to us by Freddie Mac. And by the way, all the material that I share with you this evening, we're going to go ahead and email out to you tomorrow morning so you can kind of take a look at it and make your own kind of inputs. But we're going to walk through an analysis with this tool. And as you can see, the first kind of stop with building this is going to be talking about what's our housing expense look like today. So if we're renting, which I assume many of you are, we'll put it in a monthly rent. I'm going to go ahead and plug in 2,800 just for this analysis we'll do tonight. And then as part of renting, you're obviously going to have renter's insurance. So we're going to assume maybe $15 a month in rent. And then we're going to project rental increase over the next 7 years, which our analysis is going to look over the next 7 years. So let's assume 3% a year that our rent goes up. For some of you that are getting ready to sign new leases, that could be a little bit higher. And then let's go ahead and plug in a purchase price. So I'm going to plug in $650 for right now. And I know for many of you looking at homes in Orange County or LA County, or maybe you're in a different market, that purchase price is going to vary a little bit, but let's kind of use this as a little bit of a baseline here. And then we're going to assume down payment, which on a $650 purchase price, the minimum down payment is going to be 3%. And then we'll look at property taxes. Roughly, I would say is an estimated tax on an annual basis for those property taxes will be about $7,200 a year. And then we'll look at homeowners insurance. And then homeowners insurance, roughly, we're going to say about $1,000 a year. And then we're going to assume maintenance on our house. So when we buy a house, obviously, we're responsible for any repairs we make, any kind of maintenance issues that come about. So we want to bake that maintenance into our budget as well. And then let's look at loan information. Now, we're going to talk a little bit about interest rates in just a minute, but we're going to assume a 30-year fixed mortgage. We're going to say interest rate of roughly about 4%. And origination charges are going to be what your lending costs are. Now, for those of you joining us as part of our UCI partnership, we also have a $750 discount program. So that lowers our origination cost a bit. So usually we charge a $910 processing fee. That drops down to $160 with that discount. So we'd have a $160 processing fee plus a $995 underwriting fee. Okay. So, but we're going to leave this origination charge as is, just kind of as a worst case scenario. And then discount points, and we're going to talk about that in just a bit when we get over to the topic of interest rates. But discount points allow you as a consumer to pay extra costs to be able to bring down your interest rate. Usually, well, not usually, but one discount point equals 1% of your loan amount. So let's say I want to achieve an interest rate reduction of 0.25%. Usually one discount point will provide a reduction in 0.25% for my interest rate. So if the market interest rate is 4% and I pay 1 point or 1%, potentially my interest rate would drop down to 3.75%. Okay, so that's discount points. We're not going to plug in discount points for tonight's discussion. And then other settlement charges are going to be things like title, escrow. If we do set up a taxes and insurance account for our escrow impound, that would be part of those other settlement charges. Usually I recommend that we want to factor in about 2 to 3% of our purchase price for what we call closing costs, which would encompass all of these origination charges, settlement charges, everything that we're going to have within our transaction. Okay. And then the other assumptions we want to make in this analysis is our appreciation rate of our home, let's say 3%. Expected years in the home, like I mentioned earlier, we're going to just say 7 years in this home. The cost of selling the house. So when you, as an owner, sell your house one day, you're going to pay commissions to both the buying agent and the listing agent who represents you as an owner. Now, when you're on the buy side, so if you're going out and purchasing your home now, the realtor that represents you, you won't have to pay their commissions. But as an owner, so at the end of 7 years, if I assume I'm going to sell my house in 7 years, those commissions I'm going to have to pay at that time. So we want to factor in right about 8% of selling costs. Then we have state and federal tax rate, and then finally the savings rate. So when we look at this calculator, it's going to say, okay, well, first of all, if I continue to rent for the next 7 years, it's going to cost me about $249,000. So almost $250,000 in rent over the next 7 years between my projected increases. And if I look at it from a buy side, the difference is about $149,000 in cost for my buying. That factors in my equity appreciation and my tax savings that I have as being a homeowner versus a renter. So the delta between those numbers is about $99,000 in opportunity of buying versus renting. Now, of course, when we buy the house, we're looking at about a $4,400 payment versus what we're paying today, which is about $2,800 in rent. So pretty big difference there. But the opportunity over 7 years represents almost $100,000 for you as a potential homeowner. Now, everybody's situation is going to look a little bit different. It just depends on, where I'm at from a rent perspective and where I'm looking to buy and ultimately what my purchase price is going to be. Okay, so that is our rent versus buying calculator. Let me go ahead and jump back into our slideshow now. And again, if you didn't hear me a little earlier, we're going to send out all of our material that I'm going to present to you this evening. So you'll get a chance to check this out for yourself and do your own inputs to see how that's going to impact you financially. Now, let's kind of take a look at the housing market. So this chart is going to show you housing appreciation over the last decade. And clearly over the last 2.5 years, we've seen massive appreciation rates, and it's not just isolated to the Orange County markets. We see it in Arizona in the Phoenix market. We see in Sacramento, Bay Area, Central Valley, greater Southern California. Clearly, housing appreciation has really been kind of off the hook, so to speak. And really, it's a product of limited inventory, high demand, and obviously, we've had lower interest rates, or some of the lowest interest rates we've seen on history. So that all kind of leads to just a really red hot housing market. Now we've started to see some signs as of late that things are starting to stumble a little bit. I've told some clients today, I'm meeting with them for their consultations, that maybe a little bit of a softening is occurring right now. And so as we're looking across the market, we've seen a little bit of unsteadiness when it comes to purchase prices versus appraised values. And what I mean by that is when we're purchasing a house, we have to make sure the house appraises for what we're buying it for. And what we're seeing in some transactions is a house that's not quite appraising for what the client is buying it for. And that poses an issue with the financing because ultimately that creates a gap because I only can lend on the appraised value or purchase price, whichever is less. So if I'm going to buy a house for $500,000 and only appraises for $475,000, there's a $25,000 difference that'll need to be either renegotiated with the seller or factored into your cash out of pocket for your home purchase. So we're seeing a little bit more of that frequency coming up as we're kind of going through the market with our buyers. Now, I think what that hopefully is going to do is start recalibrating some of our sellers that are going to not maybe asking for top dollar. It'll so hopefully get this market to flatten a little bit. And clearly, what we haven't seen that quite yet, but I think by transaction, we're starting to see, at least on the lending side, we're seeing a little bit of a flattening in certain markets. This slide here represents, you can see, obviously, this represents the start of the pandemic. You can kind of see the really strong upward trajectory on the housing appreciation as we look across the markets in the greater Orange County area. Now, the hope is that we'll see more inventory come to market, especially as we get into the spring and summer buying months. Traditionally, these are the busiest months coming up for us. And so it'll remain to see how much inventory we get that can help support our buyers' demand that we have in the marketplace. The other key factor that's playing right now is, what do interest rates look like? And over the last 4 weeks, we've seen interest rates, and I would say actually about a month and a half, we've seen interest rates really spike upwards. So the average interest rate was maybe around 3.5%, probably the last time I taught our UCI class. And now we're closer to 4.25%, depending on the day in the market. So as of this month, the Federal Reserve is going to increase the federal funds rate by 0.25%, which that's already kind of baked into the interest rates that we've already seen today. So that's obviously pushed the market up. And then we just have so much volatility right now in the economic climate. And obviously with what's going on currently overseas and the instability that we have right now in the geopolitical climate is just really creating some just turbulent waves right now in the financial markets. And so interest rates are varying day by day. It really just depends. Interest rates started the day we're worse today by about 0.125%. So let's say if rates were at 4%, they went up to 4.125. By the end of the day, they came right back down to close to about 4%. So it really just depends on the day. And as first-time home buyers, and we're planning for our financial futures with homeownership, interest rates are going to play a really key role in that. We hope that interest rates will kind of control themselves a bit. With what's going on right now globally, coupled with inflation levels, We're just got to kind of watch to see where interest rates go. We hope we don't see them inch closer into the mid to high fours, because we didn't expect interest rates to break past 4% this year, but they've obviously increased pretty significantly. Here's kind of the not necessarily the trajectory, but kind of the past history on interest rates. If you look at the blue line, it kind of shows what the 30-year fix has done since 1997. Clearly back in the 90s, we had rates that were touching in the 8% range, mid 8 range. And then, what we saw in kind of our bottom of the market in the middle of the pandemic, we saw about 2.625 on the 30-year fixed mortgage. And we're kind of back and forth between about a 4 to 4.25% rate loan today. Okay. Now, one of the questions we get is, how are interest rates calculated, Jason? Is just this one size fits all interest rate, and it looks a little bit different for every one of our clients. Generally, if you have a higher credit score of 740 or better, for most loans, that's going to give you the ability to be able to achieve the lowest interest rate, but it has other factors. So beyond credit eligibility, there's the type of loan that you're taking out, the loan amount that you're going to finance. Sometimes it's the type of property that you're financing, down payment. And then also the other component is going to be if you decide to buy down your rate with points. And I know we talked a little bit about that earlier this evening. The other component is the term of the loan. Now, for those of us that are first-time buyers, which is probably the majority of our class tonight, you're probably going to be doing a 30-year fixed mortgage. But if you do elect a 15, 20, maybe a 25-year fixed loan, that can come with it with a potentially lower interest rate. And what that would look like if you had a 30-year fixed mortgage at, say, 4%, and you elected to do a 15-year fixed rate, maybe that rate is 3.5% on a 15-year fixed loan. Just to kind of wrap up on interest rates, you as a consumer have the opportunity to look up any information you want with regards to interest rates. A lot of what you'll see is a lot of marketing for click ads and whatnot. So you got to be careful that there's still lenders that are out there trying to market sub 3% interest rates, but at the end of the day, those rates either don't exist or they come with it significant cost to the consumer that just does not make sense. So just something you want to be aware of as you're deciding, kind of on options for you with lending. Now, as you heard earlier, interest rates will be influenced by credit. And so what we like to do as part of our classes is to kind of talk a little bit about credit and how you can be in the best possible position with your credit. Now, when we look at the weighting for credit score, 35% of it's how I paid my bills. 15% of it's going to be is how long I've had my credit file. 20% is going to be how much credit I'm trying to get access to, also known as inquiries, especially hard inquiries. And that comes up quite a bit in my conversations with clients. We want to avoid hard inquiries as much as possible. When you apply for a mortgage or even an auto loan, the day one that you take a hard inquiry pulled on your credit, that starts a 30-day clock. And so you have the option to apply with as many lenders as you want in a 30-day window of time, and it's the equivalent of one credit inquiry hit to your score. Now, for our process, it's a little bit different. We will eventually do a hard inquiry, but for our initial conversation as part of your consultation, we only start with a soft credit pull, and that's just with Equifax, and it doesn't impact your credit score. So that's a little opportunity to be able to review your options, not having the hit to your score. Now, the last weighting for the credit model is going to be how much you owe. That's also known as credit utilization. And really, when we look at credit utilization, it takes your credit balances in aggregate versus your credit limits. Ideally, if we can keep those credit balances below 10% of our credit limit, it's going to really allow us to optimize our credit score. Now, if you're kind of running closer to 70, 80% utilization, I would recommend trying to get that and work down to below 50%. Generally, when clients can do that, they see a nice little improvement in their credit score. If you've already kind of mastered paying your bills on time and things are going great, I would say try to manage to at least 10% utilization or lower. Quick little tip to get that utilization structured properly here for your credit is to kind of look at your credit cards, and if you're trying to pay down your credit cards or pay them off, try to pay them off before the end of your billing cycle. Many of us will pay those off on our due date or pay them down on our due date. However, at the end of your billing cycle date is when the credit card issuer sends out the data to the credit bureaus. So for example, if my American Express billing cycle date ends on the 20th, but my credit card due date is not till the 4th, if I don't pay off the card until the 4th, that balance that I've accrued in that billing cycle will get posted to the bureaus and potentially hurt my credit utilization. However, if I'm able to pay off that balance before the end of the billing cycle, say by the 20th or the 19th, then that zero balance, for example, is what gets posted out to the credit bureaus, and then I have a higher credit score because my utilization is lower. Okay, so that's just a little tip to kind of look at for you as you're kind of evaluating how to maximize your credit score. Now, every loan product has a minimum credit score. So FHA loans, it's 600. Conventional, it's a 620. And by the way, with FHA, we can go down to as low as 580. So that is an option. VA, it's a 620 score. And then for the CalHFA assistance programs, which we'll talk a little bit about tonight, you can go down to as low as a 640 credit score. Just another couple things, just want to, before I wrap up on the credit slide, account closure can impact your credit score. And what I mean by that, on your revolving accounts, if you decide to close out an account because maybe you've done a balance transfer and now the new credit card issuer has better benefits, so you close out the old account, you want to be careful with that because that could hurt your credit score from a length of credit perspective, because that's 15% of your weighting. Because once you've eliminated that credit card or closed it out, it pulls away all the great history that you've had on that account. So if you've had that account for the last 10 years, you close it out, then you've lost 10 years of history into your credit score. Now, when we evaluate financing options for clients and we're looking at a 3-merge bureau or all 3 credit agencies, so Equifax, Experian, TransUnion, when we're evaluating that, we're always going to take the middle score of those 3 bureaus. So if I'm 760, 740, and 720, I'm using 740 as the score that I'm going to be able to qualify my financing off. Now, if I'm trying to qualify with my partner, but my partner has a 720, 700, and 680 score, we're going to take the lowest middle score between both borrowers. So in this case, my partner score is 700. So that's the score we'll use for qualifying. When we look at maybe some past challenges you've had with credit, this is just kind of a little matrix to show you how long they'll generally stay with you on your credit. So those hard inquiries are generally going to be with you for 2 years. If you had late payments, they're only going to impact you for probably the last year or 2 years since the date of the last payment, but they're going to stay on your credit report for at least 7 years. And of course, public records and whatnot will, in some cases, be on your report indefinitely. One of the things that we come across quite a bit for our clients is going to be student loans. And right now, I think up until June of this year, your federal student loans are going to be in deferment as part of the CARES Act with the pandemic. However, if you're trying to apply for a mortgage right now, we still need to count a minimum payment for the student loan against you for qualifying for your mortgage. There's a couple different approaches we take to that calculation. It depends on the loan product that you're electing. And usually for first-time buyers, we're going to be looking at either a conventional loan or an FHA loan. Now with conventional loans, let's say I'm on an income-based repayment amount of like $250 per month. That is the payment that we'll use for qualifying on your mortgage. Now, if you have no income-based repayment amount and maybe you're back in school, the default is 1% of your outstanding balances. So instead of $250 per month on $75,000 in debt, we're going to be counting $750 against you for qualifying. So like if you're back in school and that's why your loans are deferred, we still have to count a minimum payment against you for qualifying. On FHA loans, it's a little bit different. We're going to take the default is 0.5% of your outstanding balances. So that same $75,000 is going to be a $375 minimum payment. But the same thing holds true like a conventional loan. If you're on an income-based repayment amount, then we only count the $250 per month for the qualifying. Little trick, or not a little trick, but a little difference between the two. And we've kind of come across this as we've kind of gone through the guidelines with other clients. If you're on a zero payment with FHA, because that's your income-based repayment amount, we do need to count the minimum 0.5% against you. So FHA requires the payment to at least be beyond zero. If a conventional loan, the minimum payment is zero on an income base, then that's the payment we can use for qualifying. Any questions so far? Good. Okay, again, if you have any questions, feel free to chime in the Q&A and we'll make sure we get those answered for the group. Let's go ahead and transition into loan programs. You heard a little bit about minimum credit scores for loan programs. These are like the 5 core products that we usually work with our buyers on. So a conventional loan, which is a Fannie Mae, Freddie Mac loan, FHA loans, VA loans, USDA, and jumbo. USDA loans are going to be for clients that are trying to buy out maybe some of the rural areas. There's designated areas on the mapping for USDA that qualify certain areas. For VA, those are going to be for our veterans that have served, and there's no down payment amount required for those loans. Now, jumbo loans are a little bit different, not typical for first-time buyers, but they generally require a minimum down payment of 10 to 15%. So those are going to be for our clients that are trying to finance more than $970,800 for their home purchase. So more of the higher end stuff. One thing with jumbo loans that looks a little bit different than maybe a conventional loan or an FHA loan, they do have minimum reserve requirements. And what a reserves is assets that you have left behind after you've contributed your down payment and your closing costs. So a reserve, for example, let's say I have maybe a $5,000 monthly payment on my mortgage and my reserve requirement is 12 months. What that means is 12 months of my housing expense need to be in an asset account that's in addition to my down payment and my closing cost funds. So in that case, 12 months of reserves would be like $60,000. And so when we look at those options for first-time buyers, we got to kind of put that into our calculations to make sure as first-time buyers, we have enough assets to be able to make that requirement. Now, for the most part, especially with some of the new loan limits that we have for Orange County and LA County, that we can finance up to $970,000, we're not going to probably go into the jumbo loan category very often, but on occasion it does happen. For tonight's discussion, we really want to kind of hone in on the conventional and FHA loans. Conventional loans have a minimum down payment of 3%. That goes all the way up to a loan amount of $647,200. Now, once I go beyond $647,200, that's called the conforming limit. Once I go beyond that limit, the minimum down payment moves from 3% to 5%. And I can go all the way up to financing of $970,800. Now, with an FHA loan, the minimum down payment is 3.5%. There is no conforming limit or maximum loan amount difference. It just goes all the way up to $970,800. Now, if you're joining us from other counties like San Bernardino or maybe Riverside County, that's where you're seeking to buy, those two counties, for example, are at $647,200. And I think we actually have the county limits to share with you this evening, so you can kind of check those out. San Diego has different limits. If we get into Ventura County, those are going to have a little bit lower limits than what we see in LA and Orange County. Now, one of the big differences between conventional and FHA loans has to do with mortgage insurance. And PMI comes into play, or private mortgage insurance comes into play when we put less than 20% down in our home purchase. Now, on a conventional loan, mortgage insurance is calculated based upon your credit score, how much you put down, and then ultimately how much you finance. There's different options on how to take on your mortgage insurance. There can be a monthly option, which is you're going to have a set premium every month, generally for 10 years. There's a split MI, so you can pay some of it monthly, some of it upfront. There's also a single premium, and that's where you would pay out-of-pocket expense to buy out your mortgage insurance. And the last option is what we call as lender-paid mortgage insurance, where your interest rate is elevated a bit to be able to take the premium or absorb the premium cost of the mortgage insurance. That doesn't really happen often. Really, the most common option is going to be monthly MI. The reason for that is because MI generally has a cancellation option. So when you have 2 years in your home and 20 to 22% equity, you could potentially cancel the mortgage insurance on your financing. If we were to look at like a scenario for, say, MI on a conventional loan, maybe it's a $450,000 loan. PMI is about $183 a month, assuming a 740 credit score and a minimum down payment of 3%. So that's kind of what MI looks like. And then when you elevate your down payment, or maybe you have a higher credit score, maybe 800 or higher, that mortgage insurance will come down. The factors change based upon how much you put down. It's usually set at different tiers. So 3% down, 5%, 10% down, 15%. And then, of course, once we have 20% equity or 20% down payment, there is no mortgage insurance. FHA mortgage insurance is a little bit different. There's a set factor of 0.85% of your loan amount. And that's regardless of credit score, and it's regardless of down payment. Now, I shouldn't say that. I mean, if you put 10% down, the factor goes down to 0.80. But for the most part, clients that are going to be doing FHA are going to be putting the minimum 3.5% down. There's two parts to mortgage insurance with FHA loans. There's monthly and there's upfront mortgage insurance. Upfront is the equivalent of 1.75% of your loan amount. Now with FHA mortgage insurance, if you put the minimum down, there is no cancellation option unless you refinance the loan into, say, a different conventional loan. And then the cost of mortgage insurance looks a little bit different with FHA. On that same $450,000 loan, monthly MI is probably going to be somewhere around $324 a month. So almost probably about 45% more than what we'll see on a conventional loan. But then we also have to add that upfront mortgage insurance. The upfront mortgage insurance gets financed for you, so you don't have to influence your out-of-pocket expense, but it is an additional expense that will increase your total amount financed. So all that being said, the question would be, why would I go with an FHA loan over a conventional loan? Well, it really just depends. I mean, as you've heard earlier, FHAs have lower credit score requirements, but they also have a little more leniency in past challenges like bankruptcies, maybe some late payments on credit cards or student loans. So as we meet with clients for their consultations, we'll kind of figure out what path is best for them to go down, given their financial situation. Here's the conforming limits for this year. These limits, by the way, get updated every year. So right around end of the year, so November, December, we get these updated limits, and they're based upon cost of living adjustments. So they're the highest we've seen over the last couple of years. So and they're by county. So depending on where you're looking to purchase, we'll have the corresponding county limit. Okay, let's take a look at some of our documentation that we'll need for the home buying process. And we put this under our qualifying income. So when we're looking at our mortgage setup, we have some documentation that we're gonna need to put together. Usually it's the last 2 years of W-2s, last 30 days of pay stubs, and then us as a lender, we're gonna do a verbal and or written verification of employment. So that's for our W-2 wage earners. If you're self-employed, it's a little more complicated because we do need the last 2 years of your tax returns. We'll need to get like a profit and loss statement for you and or a balance sheet. And then we have to verify the business, whether that's, online search, business license, CPA letter, just to substantiate the business. Now, a couple of things that come up in consultations with clients or questions that we get in general, and that is, do I have to have 2 years work history for qualifying for a mortgage? And you don't need to have 2 years. You just need to show that you've either had at least 2 years of education and or work experience. So what that would look like is if, let's say I graduated from UCI in the fall and I've just started my accounting position. I went 4 years undergrad at UCI. Now I'm starting with this accounting firm. The 4 years that I had at UCI will account for my 2-year requirement. So I won't need that additional work history. So that's one way of looking at it. Now, the other question we get is, if I'm starting a new job, when can I count that income? Do I need to be on the job 6 months or whatnot? So as long as we have that 2-year and or education experience, we can count that income right away, as long as it's in a similar field. If it's a sales position and maybe you're moving from one commission job to another, we would have to wait 2 years. But if it's a base salary job and going from working from one company to the other, then we can count that new income right away for qualifying. If I have dual employment, that comes up often, whereas let's say I'm in the healthcare industry and I work 30 hours for one hospital and 20 hours for the other. In order to count both sources of income, I do have to be on both jobs simultaneously for 2 years. Same thing holds true for clients that are having maybe a W-2 job, but they also do maybe Uber Eats or drive Uber on the side. They have to show that they've demonstrated working for Uber for 2 years, as well as having their W-2 job for 2 years. So that's kind of what that'll look like. And that's something we'll review as part of a consultation, just to see what income eligibility that you have. When we look at income, we compare monthly obligations that you have: credit cards, personal loans, student loans, auto loans, as well as your monthly mortgage debt versus your pre-tax income. And it's a calculation called debt to income ratio. Usually we don't want your debt to income ratio to be more than 43 to 45% of your income. And how we calculate that is we take into consideration the principal, interest, the taxes, the insurance. We also look at PMI, so that private mortgage insurance. And if there's an HOA, if applicable, we'll take that expense plus our other debts. So like in this scenario, if we have $2,500 in housing expense and $500 in other debts, now I have $3,000 in outgoing expenses. If I divide that by maybe $8,500 a month in income, my debt to income ratio is 35.2%. For most of our first-time buyers that we work with, they generally feel pretty comfortable around a 33 to 36% debt to income ratio. The maximum it can usually be is 45%. Now, all that being said, I'm not a huge fan of the debt to income ratio because it doesn't really indicate affordability. It's just a metric that we use in lending just to determine your qualifying. So as part of our consultation with you, we're going to talk about affordability and figure out like what's the right number for you based upon your current obligations or expenses, because we're only looking at just the financial picture from what appears on your credit report and debts that you disclose to us. We don't really know any other expenses. And so we want to make sure that you feel comfortable in your housing payment, make sure it's a sustainable purchase for you, that you can, have a very successful ongoing, financial setup with your home. So that's a little bit of how we look at things from the qualifying on the income side. Now, one of the final components to qualifying for a mortgage is just your asset situation. Like, how much do I have saved in down payment? And this seems to be probably one of the biggest challenges for clients looking to purchase. Usually there's like two kind of hurdles. It's either on the credit side can be a little bit of an obstacle, or just having enough savings to be able to meet the minimum down payment requirements. As we learned earlier, conventional loan minimum down payment is 3%, FHA is 3.5%. Then when we factor in closing costs, that could be a big kind of goal for us to try to achieve. And so we're going to learn a little bit about assistance programs in just a bit. But when we look at some of the documentation that you'll need as a home buyer, if you're maybe saving money up in your checking and your savings account, we're going to need to verify like the last 2 months of statements in those accounts. We can't use cash. So if you're collecting cash at home, that can't be used in a transaction. Some cases, Venmo accounts and stuff like that can be used as long as we can paper trail it for 60 days. So any large deposits that go in and out of your checking account, those all need to be paper trailed. Potentially retirement accounts like 401ks, 403bs can use. We get the question about IRAs a little bit. And so that's kind of a TBD, because you really want to talk with your financial advisor or tax advisor about maybe potential tax consequences by accessing those funds. So you just want to be careful with that. Gift funds are something that can be also allowed in the home purchase. That's where a family member gifts funds to you. Those funds do not need to be seasoned. So most funds in a purchase need to be seasoned for 60 days. Whereas gift funds, you can get that transfer right away from a family member. Okay, so let's talk a little about the down payment assistance program through CalHFA. And what this program allows you to do is to be able to borrow at low interest your down payment, and then possibly get closing cost assistance at 0 interest. And so the way this works is CalHFA is the California Housing Finance Agency, and it's designed to help low to moderate income first-time home buyers. And we're pleased to be the leading provider of this program across the state. So it's really great to be able to share this with you in a Zoom format like this. This is one of the options that we'll talk a little bit about as part of your consultation with us. And how the program works is you have two different components to CalHFA. You have the My Home Assistance, which is designed to help you out with your down payment. And it can be anywhere between 3% to 3.5% of your purchase price. It's a 1% simple interest loan, but it does not require repayment until you either sell your home or if you refinance in the future. Now, the $15,000 max that we have on this slide, this is actually hasn't been updated yet. Just about a week ago, CalHFA just lifted the maximum amount on these programs. So you can get up to a full 3 or 3.5% of your purchase price. And it really is helpful in some of our high cost of living markets like LA County, Orange County, the Bay Area. So if you're buying at the $700,000 mark, last month you were capped at $15,000 in assistance, where this year you can get up to $21,000 in assistance. And it gets a 1% simple interest loan. So it accrues interest on an annual basis, and you don't have to pay it back until you either sell your home or if you refinance in the future. And now we can take that My Home Assistance for the down payment side of things and combine it with the ZIP assistance. And ZIP allows you to borrow 2 to 3% of your loan amount interest-free. And again, you don't have to pay it back until you sell or refinance in the future. Now, I will tell you that as we add on assistance levels to your financing, the interest rates will change with CalHFA. So that's something we want to look at as you're kind of preparing for buying. We'll look at different interest rate scenarios if you want to incorporate the assistance as part of your financing packages. Let's take a look at a conventional purchase, like as a traditional approach with just savings. And then let's also look at it as a CalHFA assistance program. So let's say we bought a house for $500,000, minimum down payment's 3%, which would be $15,000. Now we also need to save some money for closing costs, and that can be anywhere between $10,000 to $15,000. So if we just were looking at a standard conventional 30-year fixed mortgage, we're probably going to need to save anywhere between $25,000 to $30,000. So for many of us that come to our classes that we teach, that's probably going to be maybe a year, 2-year goal. However, if we look at this same financing structure, now we overlay with the CalHFA assistance, that My Home Assistance will cover this entire $15,000 down payment requirement. Plus, we would get anywhere between $9,700 to maybe $14,550 in closing cost assistance through the ZIP program. And so instead of having maybe to worry about the $25,000 to $30,000 out of pocket, now we could be in a position where we maybe putting no money out of pocket. Maybe it's $4,000 to $6,000 out of pocket, depending on how we want to set up our different assistance levels. So that obviously makes home buying so much more reachable for us. Now, FHA has the same option as a conventional loan. It's just the down payment minimum's 3.5% versus 3% on a conventional. So we can set up the same type of financing structure. So if we look at an FHA loan with the minimum down payment of $17,500, the My Home Assistance can still do the same thing, can offset that requirement, and then we can also add in the 2 to 3% ZIP assistance. So I want to just pause there for a second. Do we have any questions on that, Ken?
No, yeah, we're good.
Okay. We're going to walk you through this. This is a program that's of interest to you. We're going to take you through this as part of a consultation, just so you can see how that can kind of reduce the asset contribution that you have to make for your home purchase. Now, there is some eligibility requirements. In fact, this is another enhancement to CalHFA. They just reduced down the minimum credit score requirements from 660 down to 640. So for an FHA loan, the minimum credit score is 640. For a conventional loan, the minimum credit score is a 680. Now, if you're looking at a manufactured house, there's some different requirements. But the base is a 640 credit score. Now, there's the debt to income ratio, which you learned a few minutes ago. That maximum is 45% with CalHFA. When we evaluate eligibility from an income perspective, it's only based upon the applicant's income, not the household size income. And why that's important is the maximum income in Orange County is $211,000. So if I'm just applying on the loan by myself, and let's say I make $120,000 a year, and my partner makes $100,000, well, combined we exceed the income limits. But if I'm able to qualify in just my income, then we could still be potentially eligible for the assistance program. I just wouldn't be including my partner's income because even though that's in the household income. And then a first-time buyer, which many of our clients don't realize this, a first-time buyer is someone that hasn't owned in the last 3 years. Okay, so if you owned back in 2010 and you sold in 2015, as of now, you would be eligible as a first-time buyer. Now, the income limits are $211,000 for Orange County, LA's $158,000. You can see Riverside, San Bernardino, $153,000. These income limits get adjusted every June based upon cost of living again. So in just a couple months, we'll see these income limits get updated again. My sense is obviously they're going to go up again based upon what we've seen in the adjustments with conforming loan limits as well. So that's the CalHFA assistance program. Now I want to just kind of share with you one more program benefit before we move into some of our final items with tonight's discussion. That's our medical professionals program. It's designed to help medical doctors, dentists, teaching professors, medical teaching professors, and newly licensed medical residents. And where this program can be beneficial is when we look at that student loan debt calculation that we saw earlier this evening. It allows us to have a little more flexibility in the qualifying for student loan payments. So it'll allow us to maybe pull that out of the equation, especially if we have someone that has $200,000 or $300,000 in maybe medical student debt, we can pull that out of the equation, maybe help create a little bit better purchasing power. So the medical professionals program does have minimum credit scores of 700, but it's going to allow us to reach clients that are beyond the conforming limits. And then again, needs a little more flexibility with student loan obligations.
What's the timetable on a foreclosure with FHA or conventional?
Okay, so a question just came in. So with the foreclosures on FHA, that's 3 years out on a foreclosure. And then it's 2 years on a short sale. Okay. Well, we got some questions. If you have more questions coming in, I know we definitely will tackle those tonight. And again, we're going to stay after I wrap up tonight's discussion. We'll stick around for some Q&A as well. So I'm going to now walk you through what we call the 6 steps of home buying. And this is a process we created just to give you kind of this visual tool to see what it looks like to go through all the milestones of purchasing a home. The first step in the process is to be pre-approved. And just so you know, that pre-approval is the output of a consultation with us. So the consultation is a one-on-one that we do to kind of design a home buying game plan for you. The pre-approval is usually good for 60 days. But we can always recertify it at any time, especially a lot of our buyers that have been pre-approved in 2021, just because of lack of options of inventory. A lot of them are going back out and shopping now this year. So we can always recertify it for you at any time. So, but generally it's good for 60 days. Now, what's a pre-approval is that it's a pre-approval certificate that gets presented to the seller of a home when you have interest in a property. So if you're out home buying, which by the way is step 2 in the process. So if you're out looking for homes and you decide to make an offer on a house, that pre-approval gets presented to the seller to show that your financing has been all validated. Now, step 2 is house hunting. So that's when you get a chance to connect with the realtor to be able to help show you different options. Now, I know for all of us on tonight's call, we have the option of getting on Zillow or Redfin and checking out the different options available. But a realtor is trained in their particular market and understands what's available out there, what homes are financeable. As you heard earlier, realtors are paid for by the seller. So I always encourage our buyers to take advantage of that resource. I think it's really important, especially as first-time buyers. Now, we do have a network of preferred realtors that we work with, realtors that we really trust in the buying experience. So for those of you that do need the connection of a realtor, we're more than happy to make that introduction once you're pre-approved. Now, by the way, a pre-approval letter will get updated as you go through the home buying process. We generally will update a pre-approval to match whatever it is your offer price is. So let's say I get pre-approved for $600,000, but I fall in love with a $575,000 house, and that's my offer price. We'll update the pre-approval to match that $575,000 offer price. So that's kind of what we do as we move through the process. Some realtors, it doesn't make a difference. They just would rather keep the pre-approval and then they'll make offers. But other realtors will want us to adjust it for each offer, and we're fine with either approach. So let's say we make an offer on a house, the offer gets accepted, then we're going to move to the next milestone, and that's called entering escrow. And that means we have an accepted offer with the seller. That escrow process is usually 30 days. So the seller has accepted our offer. Now we're on this timeline of 30 days before we're going to get the keys to our house. Your requirement as a buyer is usually within 2 to 3 days, you're going to need to make what we call an earnest money deposit. That usually is 1 to 2% of your sales price. And we're going to talk about that in just a bit. You're also going to get a call from us within 24 hours of your acceptance. In fact, that's one of my calls I was doing before we started tonight's discussion to congratulate our buyers on their accepted offer. And then we're going to schedule you for a follow-up video call. And that's where we get a chance to go back through your financing. So you usually have a consultation done prior to pre-approval and another consultation done once you have an accepted offer. Now we're going to be on that 30-day timeline. So it's really important for us to start ordering the appraisal of the property, which we handle as a lender. Your realtor will handle your inspection ordering. And then within 24 hours from that point, we're going to deliver to you initial disclosures. At the follow-up consultation that we do with you, we're going to talk a little bit about interest rate strategies, out-of-pocket expenses, monthly payments, just so you have a really clear, transparent picture of everything that's going on with your financing. The next milestone is step 4, and that's processing and underwriting. That's where our team will be verifying your employment, your assets. We may ask for a few other pieces of documentation just to make sure everything is current, or we may need some explanation on certain items that we receive. Generally, by that point, your rate lock will be completed. And that's a discussion we have as part of your follow-up consultation, but we'll probably execute on the rate lock sooner than later, just given the volatility in the market. And at step 4, we'll also submit your loan to our underwriting team. And once our underwriting team has completed our review of your loan, that will issue what we call as a loan approval. And the loan approval is the underwriter saying that all the financing is fully qualified. We've done all our verifications. The appraisal is back. And that is part of one of what we call the contingencies. And I think we have a contingency slide here, don't we? So the contingencies, just so we're clear here, the contingencies allow you to do your due diligence on the property. Usually the contingencies are within the first 14 to 17 days of your contract. So it allows you as a buyer to get the house appraised, get your inspections completed, and get your loan approved. And so, like I said, those will happen in the first 14 to 17 days of your contract. And why that's important is because it completely protects your deposit. So let's say I get my inspections back and there's $50,000 worth of dry rot and the seller's unwilling to repair those items. Then as a buyer, I could potentially cancel the contract and get a full refund of my deposit. So really super important. Now, when we get to step 5, we're probably going to be at the end of our contingency period. And so we're about 3/4 of the way through the process. So at step 5, you're probably going to be asked to remove your contingency. So as long as you feel comfortable in the process, you'll make that removal. We just want to make sure that we're comfortable moving forward, because once you've removed contingency, there's kind of a no turning back. Because if you cancel 2 days later after removing contingency, then you could risk losing your deposit. So you just want to make sure that you feel really good about this property. One of the things we're going to be doing as a lender at step 5 is issuing a final closing disclosure. And that gives you a 3-day cooling off period as a consumer to make sure the loan is everything that you expected: interest rate, payment, your out-of-pocket expense. And once that cooling off period has elapsed, that'll take us to the very final milestone, and that's called closing your loan. And that's where we get to sign final documents. Those are done in person with a public notary. That takes about an hour, maybe an hour and a half or so. Once you've completed that, you'll wire in the final funds of your purchase. That money gets received by what we call an escrow company. After that's done, us as a lender will do one more final audit of your loan. We just want to make sure all the signatures are correct on your financing. And if everything looks good, then we'll wire in the funds for the mortgage. If you've elected any assistance programs, we also take care of the wiring of that as well, because we're actually financing that. And the money gets reconciled by what we call an escrow officer. That person ensures that you as a buyer have contributed what you're supposed to on your home purchase, and the seller's receiving their appropriate funds. If everything balances out and everything's all good, then they'll release documents to the county recorder's office. The county recorder will record a grant deed, and that transfers ownership over to you, the new owners. And then they'll also record a deed of trust, and that's the security agreement for your loan. So basically that agreement tells you of the repayment terms of your loan. And once we've got confirmation of those recordable documents, then you actually become the official owner of the property. So that confirmation comes in, we're going to reach out to you, congratulate you, high five, virtually high five of the huge accomplishment. And then once we've got that confirmation, you're going to make arrangements to get your keys from your realtor. Okay, then you can go out, take all your pictures in front of your house, post them on social media, tell them what a great experience you've had, all that stuff. So it's a big accomplishment. As I kind of kicked off tonight, it's probably going to be one of the largest purchases you make in your lifetime. So certainly something to celebrate. Let me back up just a second. Our slides got a little fast on us. You've heard me mention a little bit about consultations a few times this evening. So what a consultation again does, it's basically a home buying game plan for you. It's a non-obligation type of thing. It's a free service we provide. We want to be the leader in home buyer education, and we feel like doing consultations, best informing our clients that they're going to get them best prepared to be able to have a successful home purchase. So the consultation is just an in-depth analysis. I'm going to show you kind of what the framework looks like in a little bit. But if you want to schedule one of those consultations, you can submit your online application, upload some of these documents that we show here, and then schedule that consultation. I suggest doing it over video just like this, because then I can screen share with you, show you what different scenarios look like. We can kind of build that plan together. And then, like I said, the output of that conversation is to have you pre-approved. Now, if you didn't get a chance to, maybe ask your question this evening, and maybe you have a, maybe more of a detailed question you want to go through, or kind of go through your scenario, or maybe understand better the next steps in the home process, I would love to schedule an introductory phone call with you. So that's just a phone call, maybe 10, 15 minutes, just to get better understand or assess your scenario. And then we can explain those next steps in the process. The free consultation that we provide looks a little bit like this. So we're going to get a better understanding of where we're at rent-wise. So what are we paying in rent? What's the location we're looking at? What's our budget going to be? Get a good sense of what different neighborhoods you want to look at, what type of property you're looking for. We'll talk about interest rates, costs, out-of-pocket expense. I'll show you what your debt to income ratio looks like. We'll review credit. We can put together credit game plans as if you need to kind of get you on the track with credit. And then we'll kind of walk you through the process again, make sure you feel good about those 6 steps of home buying. And then, like I said, the output of a consultation is to have you pre-approved. So, and that'll start the journey towards step 2. We have some really great tools available to you as well. So we have our mobile app. It's available for Android and Apple. So you can start the process right from your mobile. You can also follow the kind of the progress of your loan. There's also calculators there as well. So I really encourage you to take a look at our mobile tools that are out there. I think it'd be really useful for you. You can even submit some of your documents for your pre-approval. Now, many of you that are joining us this evening heard about this workshop through our UCI partnership, which we're super proud to be a part of. We also have other partnerships across California and in other states as well, like Arizona. And we provide a discount as part of those partnerships where we get a chance to reduce some of our costs in closing. So it's a $750 discount. If you're not joining us from UCI, maybe you're affiliated with one of our other partnerships, or maybe you're a California state employee, that same discount applies. So really great incentive there for you as well. And again, these consultations are free. So if it's something you want to do, it's a no expense type of thing and no obligation as well. And again, we'll be able a chance to build your home buying game plan through that consultation. We really want to be your trusted mortgage advisor in the process. That's why we lead with education. We provide that value to you, and we want to be part of you on this journey towards homeownership. We want to make it a high touch experience. Now, we do have other workshops that are available throughout the year. So you're attending the March 8th one. We're doing another one for our Long Beach partnership, and we have others scheduled throughout the year. So if you really like some of this content, you want friends, family, maybe some coworkers to check it out, feel free to have them check out mortgageeducate.com, and they can attend one of the upcoming sessions that we have. And like I said, those are about 45 minutes to an hour-long sessions, and we're going to be doing different tune-ups throughout the year as well. We're going to hang out for some questions because we got a few more minutes, and we'll stay as long as we need to make sure we get all our questions answered. Here's all my contact information. So if you need to reach me by email, you want to message me, there's my text message as well. You can get a hold of me one way or another. Also give me a call, and you can schedule that appointment either for the intro call or a consultation using that link as well. And finally, just before I wrap up on the slide, just want to say that, we love what our clients are saying about us. We really are proud about our Google reviews, Yelp reviews. And then we also try to celebrate homeownership through our social channels, through Instagram, through Facebook, because this is a big deal. This is probably going to be one of the largest investments we make. And so once we get to the finish line at step 6, we want to make sure we celebrate that with you guys. So with that said, we really appreciate you joining this evening. I'm going to hang out for a little bit, see if you have any questions. I'll shut off video and then kind of pop back in do we have questions right now? Okay. So looks like we had one question come in. I think I'll go ahead and I'm going to go ahead and mute out for a second, and then I'll pop back in with an answer. Okay, I'm going to chime back in here. So we had one question that came in, that was around what type of credit report are we going to run for the pre-approval? So that is a soft credit pull. So it's not going to be a hard inquiry. So that's through Equifax. And I think the question came up as a pre-qual. So we don't do pre-quals. We only do pre-approvals. And quite honestly, pre-approvals are only thing that's really going to work in the market right now, because the difference between a pre-qual and a pre-approval, a pre-qual is just a lender looking at your credit in your application, whereas a pre-approval is a lender looking at credit, income, assets, and your application. So it's just much more in depth, and sellers really want to see that in order to accept your offer.
Does the lending process differ for new build homes? Are you required to use the builder's lender?
So another question came in for new build homes. Is the process look any different? So the process will still be on the same 6 steps of home buying. The only difference is versus being on a 30-day timeline, it'll differ by how long construction takes. So usually we'll go all the way through the 6 steps, and then we'll stop at step 5 while we're waiting for construction to be completed. And then usually within 30 days from the completion date, we'll order, I shouldn't say, probably like 60 days from the completion date, we'll order an appraisal of the property. That's just part of our process. And then once we know the completion date, then we'll move to step 6, and you should have your keys on the date of completion. Now, all that being said, construction's a little backlog because of supply chain issues, so we're seeing some movement on those dates. The other question came in is, if you buy a new build, do you have to use the in-house lender? And that's a really good question, because the answer is no. I know a lot of lenders try to incentivize consumers for using the in-house. What we find is that sometimes the product selection is not the same. So we always encourage clients to get second opinions. We love to be a lending choice for clients looking at that. Especially if you're interested in CalHFA assistance programs. Most in-house builder lenders don't do that.
Another one, if you have 2 W-2 jobs, but you haven't been on the second job for 2 years or more, does that mean you can't use that second job towards your income?
Okay, so we had an income question that came in. So if you have 2 W-2 jobs and you've been on the second job less than 2 years, that means you can't use that second job. So unfortunately, you would not be able to use the second job. We can certainly use the primary first job, but the second could not be used until we reached 2 years for both the first year and the second year combined. And the whole rationale behind that is underwriting wants to see that it's sustainable to be able to hold down 2 jobs. And so if you can demonstrate that for 2 years, then that's when we can use both sources of income.
Another question, is there any difference in interest rate once you get over the 740 score? Say if someone has an 800, will they get a better rate than someone that has 740?
Okay, yeah, so question was, if we get over the 740 credit score, is there a difference in the interest rate? So on a conventional loan or FHA loan, no. So once you're over 740 plus, you're gonna get the best available interest rates. Now, if you're doing a jumbo loan and your 800 credit score, that might look a little bit different. So that'll be kind of a case by case. Where it's probably going to be more beneficial is on the mortgage insurance side. So if you're over a 740 score, mortgage insurance will lessen. Usually it's tiered at 740, 680, 780, 800. And once I hit 800 and above, I'll get the lowest available mortgage insurance. Oh. Great questions though, everyone. So I think we've got a couple more coming.
Both W-2 jobs for less than 2 years, then how would you determine it?
Okay, so now the question came in is we have both 2 years W-2 employment for both jobs. So we'll have to, and the question is, how do we calculate that? So we'll have to look at the average hours for each job. So it just depends. We'll have to kind of maybe talk offline on that. Depends on how many hours we're working at each position. Usually, we're going to do an average of hours based upon what we get back from a verification of employment from each of those jobs. And then of course, average hours times hourly wage, but it'll just be dependent upon, what type of income structure those positions have.
Another question, if you sell a home, how much time do you get to buy another home without getting taxed on capital gains?
So the question came in, how long do we have before, I get taxed on capital gains if I sell a house and buy another one? So unfortunately, I'm not a tax advisor, so I wouldn't want to advise on that. There is things though, called a 1031 exchange that allows you to take the sale proceeds and put them back into another purchase. I would encourage you with that question, talk to your tax advisor. They can hopefully give you some tools and resources to maybe see if there's maybe a workaround to capital gains. But that would probably be more suited for those experts.
Another question. So for a conventional loan, reserve assets are not required, but can they help?
So question came is reserves, are there reserves required for conventional loans? So generally speaking, reserves are not required, but they can be a compensating factor, especially if I have a lesser down payment or I have maybe a lower credit score. So when we run loans through the system, and this is for every lender, they go through what we call is either desktop underwriting or a loan prospector, and those are both automated systems that evaluate credit risk. So they look at credit, they look at income, they look at assets, they look at the overall kind of capacity to pay. And if we have more reserves, then that reserve will be a compensating factor to help, maybe offset maybe challenges in some of those other areas. Great questions. I'm glad everybody held their questions to the very end. Okay. I think we may be wrapping up on questions here. So let's see if we have any more coming in. None? Okay. So I think we may be at the end on questions. Now, you can always reach out to us, catch us offline if you have a particular scenario you want to run by us. You have all my contact information here, so feel free to reach out. And hopefully I get a chance to connect with each of you for your consultation and help build that home buying game plan. Thanks again for joining us this evening. It's a pleasure bringing this content to you. We'll be doing this again for our UCI team here just in about 2 or 3 months. We're teaching workshops tomorrow and next week as well. So like I said, if you have any friends, family, coworkers that want to join that, we'd love to be able to share this information with them as well. So enjoy.